Not long ago, growth in business was easy to recognize. You saw it everywhere. More employees, more offices, more products, more customers. Growth was loud, visible, and often aggressive. If a company was expanding quickly, it was considered successful. That was the standard. But today, something has changed. Growth is still happening, but it doesn't look the same anymore. In fact, in many cases, it's harder to see. Because growth is no longer just about getting bigger, it's about getting stronger. To understand why, you have to go back to how businesses used to operate. For years, the focus was simple: expand as fast as possible, enter new markets, acquire users quickly, launch more products, scale aggressively. The idea was that size would eventually solve everything. If you grew large enough, profitability would follow. And for a while, that approach worked. But it came with hidden problems. As companies expanded rapidly, they also became more complex. Costs increased. Systems became harder to manage. Inefficiencies started to build beneath the surface. And those inefficiencies were easy to ignore because growth covered them up. When revenue is increasing quickly, problems don't feel urgent. But when conditions change, those problems become visible. And that's exactly what started to happen. Costs went up, competition increased, capital became harder to access, and suddenly growth alone wasn't enough. Because if growth wasn't profitable, it became a risk instead of an advantage. This is where the definition of growth started to shift. Companies began asking a different question: not just how fast are we growing, but how well are we growing? And that question changes everything, because now growth is not just about scale, it's about quality. You can see this in how businesses operate today. Instead of expanding aggressively, many are refining, improving margins, reducing unnecessary costs, optimizing operations. These things don't always show up as dramatic increases in size, but they make the business stronger. And that strength is a new form of growth. Another major shift is focus. In the past, companies tried to do more markets, more features, more offerings. Now, many are doing less, but doing it better. They're narrowing their scope to what actually works, cutting underperforming products, focusing on their strongest areas, and by doing that, they improve efficiency and profitability. So instead of growing outward, they're growing inward, strengthening the core of the business, and that kind of growth is quieter, but more sustainable. There's also a shift in how success is measured. Growth used to be about volume: how many users, how much revenue. Now, those numbers still matter, but they're not enough on their own. Companies are looking deeper. How profitable is that revenue? How long do customers stay? How much does it cost to serve them? Because not all growth is equal. A company can grow quickly while losing money. It can acquire customers who leave just as fast. It can expand into areas that don't make sense long-term. So growth is being redefined. It's no longer just about increasing numbers. It's about improving the business itself. Another important change is the role of retention. In the past, growth was driven mainly by acquiring new customers. More customers meant more growth. But now keeping customers is just as important, if not more. Because retained customers generate consistent revenue over time, they are more predictable, and they are more efficient. So growth is no longer just about adding new people, it's about keeping existing ones longer. And that creates a different kind of expansion, not outward, but over time. The longer a customer stays, the more the business grows. And that growth is less visible, but very powerful. There's also a financial shift behind all of this. Capital is no longer as easy to access as it once was. Investors are more focused on fundamentals. Profitability, cash flow, and efficiency matter more. So companies can't rely on external funding to support growth indefinitely. They have to sustain it themselves. And that forces a different approach. Growth has to make sense financially. It has to be controlled. It has to be sustainable. And that naturally changes how it looks. Another reason growth feels different today is because it's happening through small improvements rather than big moves. In the past, growth often came from major actions: a big product launch, a large acquisition, a new market expansion. Now, growth is often the result of continuous refinement, Small changes that improve performance over time, better pricing, improved customer experience, more efficient systems. Each change might seem minor, but together they create meaningful progress. And because this happens gradually, it doesn't feel as dramatic, but it's often more effective. There's also a mindset shift happening. Growth used to be the goal. Now growth is becoming the result of building a strong, efficient, well-run business. Instead of chasing growth directly, companies are focusing on fundamentals, and growth follows from that. But here's the key point. Growth hasn't disappeared, it's evolved. It's become more disciplined, more focused, more aligned with profitability, and less dependent on speed alone. So when you look at businesses today, you might not always see rapid expansion, you might not see huge jumps in size, but underneath, something important is happening. Companies are becoming more efficient, more resilient, more sustainable, and that is growth, just in a different form. Because in today's environment, getting bigger is not enough. You have to get stronger, and strength doesn't always show up in headlines. It shows up in consistency, in margins, in long-term performance. So growth looks different than it used to. Less flashy, less aggressive, less about scale alone, and more about quality, control, and sustainability. Because the definition has changed. It's no longer just about how much you grow, it's about how well you grow, and that shift is shaping the future of business.